Thank you. So I'm going to start today by asking my panelists to quickly introduce themselves.
Yeah, should I start? I'm Kai Afflerbach from Frachtcontor Capital Partners. We are advisors and brokers for financing out of Hamburg. The Frachtcontor Group, however, has multiple offices all over the world with a very strong tanker and dry cargo desk.
Stephen Fewster, ING Bank, running the bank's shipping finance portfolio, non-executive director of the Wallam Group and a member of the advisory board to Lloyd's Register. Oh, and vice chair for Poseidon Principles, how could I forget? I saw Michael in the front pulling a face at me.
Paul Taylor, Global Head of Maritime at Societe Generale, and as of the 1st of January, Chairman of the Poseidon Principles.
Gaurav Moolwaney, Regional Head for Transportation Finance at Standard Chartered Bank.
Mickey Belgrod. First Citizens Bank, Mickey Belgrod.
Thank you. Thanks, guys. Before we turn to our panel discussion, I'd like to begin with just a few acknowledgements. I wanted to acknowledge Michael Parker from Citi, whose vision and leadership have guided the Poseidon Principles since their inception. He's led the Poseidon Principles with remarkable commitment for the last 6 years, and now he hands that baton on to Paul Taylor from SocGen. So heartiest congratulations, Paul. And while we're on milestones, I also wanted to recognise Steve Fewster, who after 40 years in ship finance, including 23 at ING, is stepping down at the end of June. We'll really miss you, Steve, in this context in the industry. You've had an exceptional career, and you'll be obviously handing on a great legacy to your colleagues, Robertus, who'll take over heading up London, and Gerbrand, who'll be the global head.
Thank you very much.
So turning now to the format of our panel, we're here at a fascinating moment for ship finance. Years of strong cash flow have strengthened balance sheets. Bank pricing is competitive where leverage is modest. Private credit has scaled, and leasing, longer central pillar, faces a more nuanced outlook in light of policy and regional shifts. All of that focus is a sharper conversation about where capital is most active, what terms are sustainable, and how lenders want to show up for their clients. Today we've split our sort of panel discussion into 5 themes. We're going to start by looking at market dynamics and capital sources. Who is actually financing this market today, at what depth and on what terms? Then we'll look a little bit at risk, structure and credit appetite, how tenor, amortization and covenants are being calibrated, especially if earnings soften. It wouldn't be a panel without decarbonisation, so we'll turn then to decarbonisation, fuel tech and Basel IV. What's truly bankable, how evolving technologies are underwritten, and whether ECA capability is now a competitive edge. Then we'll turn to the sort of topic that is very in focus today, geopolitics, sanctions, and strategic geographies, how compliance, trade routes, and regional risk are reshaping credit. And we'll end with competition strategy and borrower behaviour, how institutions differentiate where they deploy capital, and what behaviours from owners help or hinder execution. So I'll start each theme with one broad question aimed at each panellist, and then we'll open it up for debate amongst our panellists. So with that, we'll get started. Kai, given your vantage point across banks, private credit, leasing, and newer pools of capital, how has the balance really shifted over the past 12 to 18 months? How is that showing up in leveraged deals, covenant terms, and the way lenders are positioning themselves in a competitive market? How accurate is the narrative around a retreat from Chinese leasing and refinancing away from it? And finally, is private credit now a structural component of the ship finance ecosystem, or do owners still see it as a cyclical response to higher rates and bank constraints?
Thanks, Kavita. There are quite a lot of questions. I'll quickly cover all of it. Well, if we look at the environment we have today, maybe it's interesting to see how it was 12, 18 months ago, and how it shifted. And well, the first stop, maybe even until last year, early last year, definitely in 2024, at least for new buildings, was always, is there Chinese leasing? So and if the answer would be no, you would go to someone else, to a bank or private credit or whatever. But it was always, well, most of the time, it would have been Chinese leasing. And look where we are now, very much triggered through the politics of the US in terms of port fees. And if you recall last summer, for many ship owners, it was a discussion, not only do we pull out, or not only do we have alternative means, but do we pull out? Do we need to cancel our Chinese leasing financings? And if we look at it now, obviously there haven't been an exodus. Some have tried to cancel it, but the overall view now is that Chinese leasing is not necessarily, at least not for European owners, the first way to go, and the banks really came back. At the same time, I think it's quite interesting to see that Chinese leasing also shifted. One could have expected that there's an aggressive way of Chinese leasing, seeing that they're losing projects, that they get even more aggressive, but that's not the case. So what we see is that Chinese leasing houses are even less aggressive. There's no more high leverage, non-recourse financing to cutthroat rates, but it's getting more conservative. And they are kind of moving towards the banks, and the banks on the other side get a bit more sporty, I want to say. I mean, the leverage is getting a bit up, rates are coming, or margins are coming down, so they're actually getting closer, which means for the owners, it's even less attractive to speak at first to Chinese leasing, because the banks almost can do what they've done in the past, or what they can do now, and not doing like they did in the past. In terms of alternative capital and alternative means of financing, I think the market has broadened a lot. Probably not so much for the tools itself, because many of them have been there, but very much in who is applying them. And what we see is that even smaller and mid-sized owners have educated themselves and using that tools now. As a last point, I see that banks are now less reluctant to go along. So it's a bit more of a mixture that you've got the debt from the banks, mortgage secured, and then you have probably mezzanine and preferred equity or whatever, all working together on one project. And I would say that's quite unique in the scale we see it now, because as I said, I mean, that's not only the well-educated and bigger shipping companies, but also the smaller ship owners, which are not afraid anymore to look at those structures and are quite successful with it.
Steve, do you want to go?
Well, it's very difficult to generalise, I think, and of course, we operate each of us, in probably slightly different markets, and therefore perhaps what I see is different to what Kai sees. I don't think we were seeing our clients doing a lot of Chinese leases a couple of years ago. Certainly there were some, but generally the terms you were getting out of Chinese leasing were, in my view, aggressive, high advance rates, etc., long profiles. And our client base didn't really want to do that because for them, and I agree with this, of course, is what they really wanted was low break-even rates, so that when the market comes off, they know they can carry on trading without too much difficulty. We did see a flurry of activity away from Chinese leasing, and we financed something like about 40 ships, roughly, away from Chinese leasing last autumn. That was not just us, but in syndicates as well. That has stopped. But of course, some owners who did have Chinese leases decided that they could sort of re-engineer their trading pattern. And if you weren't going into the US, it wasn't so much of a problem. So that was one of the limiting factors. I haven't seen Chinese leasing come back, which isn't to say it hasn't, but I haven't seen it. We are seeing JOLCOs being used more frequently, I would say, and they seem to be quite an attractive source of financing. Of course, it still requires bank debt, but from a tax perspective, for the Japanese tax investors, they can actually provide very low-cost overall pricing. What was the rest of the points?
I wondered, Paul, if you wanted to come in on the different financier types in the same deal. And
Well, I won't repeat a thing.
Sorry, maybe I'll just be very quick. So private credit, again, we don't really see that in our market because that tends to be for the higher risk transactions because the investors need typically returns well in excess of 10%, which we just don't get from our client base. Personally, I'd be a bit worried about using private credit too much. I think it's the hot money. And I don't know if anybody saw the FT I think it was Tuesday this week, there was quite a big article on private credit, which has become retailized, I think that's the right expression, which basically what that means is there's now a lot of private credit funds where individuals like you and me can invest in. But what you see and what you've seen with the collapse, I think, is its value part, I think it is this US group, that's really frightened a lot of retail investors into private credit. And we saw at the end of last year, $7 billion withdrawn from private credit funds. So I would be a little bit wary about private credit, but that's just my view as a very, very conservative banker.
Yeah, not at all. I'll be very brief, but I mean, it's still a bank-led market, and we expect the pricing gap between the bank market and private credit to narrow, but and we probably expect it to happen by now, but it hasn't. And with bank regulation changing with Basel IV, we do expect the pricing to go up. It's going to have to go up at some point, certainly when the market changes, and maybe that the shrinkage in that gap maybe will lead to more companies going towards private credit. But at the moment, it just doesn't work for most of the stronger names. It's still bank market, it's still Chinese leasing, and I think we've got to be very careful in what we want from Chinese leasing. Yes, of course, there's opportunities for European banks to refinance the facilities that are currently under Chinese lease because of the uncertainty. But actually, it's in everybody's interest that the Chinese lessors are in the market. If suddenly they disappeared, there'd be eventually quite a big hole, and we need that hole to be filled. So we want the Chinese lessors to remain, but
Pricing would go up, though.
but pricing would go up.
I'd just like to add, so I'll take a slight counterpoint to Kai. Paul told me a little controversy is always good. So for the longer-term charter-backed infrastructure type new building projects that we see sometimes, may have an infrastructure fund backing it from the sponsor standpoint. And a lot of those sponsor dollars tend to come from the US market. You start to see a bit of a shift away from the Chinese leasing, but not entirely, and slightly begrudgingly, because those terms are very attractive. The leverage, you can't beat it, and on a fixed rate, very structured, long-term transaction, you're putting a lot of the variables away, and that makes for a very nice coupon that you can clip as an infrastructure fund. So we've seen some shift to the Western banks, ourselves included, but it's not something that they're doing happily, just because it feels a little bit more of a requirement to diversify, to be good fiduciaries for their shareholders.
Gaurav, moving on to you. From your perspective, how is the current risk environment shaping the way you think about tenor, amortization, overall deal structure? Are credit teams genuinely rediscovering comfort with new builds? And do the terms being written today still make sense if earnings are going to pull back? And then wrapped around all of that, do you feel like you're being properly compensated for the geopolitical and regulatory risks that banks are carrying at the moment?
I don't think any bank can claim to be properly compensated in today's market. But taking a little bit around your risk and appetite and all of those questions first, I think the way we see this is there is a lot of appetite on the banks. I think what we have seen is just a function of where the markets have been over the last 4 or 5 years. Right? All our clients have done exceptionally well. Our credit teams have never been this happy looking at our client profiles. Right? And we joke about how a lot of the shipping industries on a proxy basis, almost quasi-investment grade, which has always been a crossover on a best day, is looking like an investment grade portfolio today. But that's where we are today. Credit teams are happy. And I also feel like what we've seen in the last year is that a lot of the clients have not been pushing the risk terms very much because, again, they are flush and they don't see the need to stretch. However, we also see some of this changing, right? And I think that is coming down to a lot of the pricing competition that we've seen in the markets. I think for now, it seems like most of the banks have been very happy competing on pricing. And we've seen a severe compression in the last, every month or 2 months, I hear another 10 basis being shaved off. Now, at some point, when you can't compete on pricing anymore, I feel like it's going to go down that risk question. Now, in the past, if you could not compete on pricing, you just went down the credit curve and just gave money to a different credit portfolio. But I worry that at some point, you're just going to start loosening terms, because if you can't compete on price alone, then you have to give something else, because everybody has bills to pay. And that's when you're going to start seeing a shift. Now, having a weaker credit portfolio, which is richly priced, is still okay, because you're compensating it off to some point. I think where it'll be a bit worrying is you have a weaker credit portfolio, which is not priced to market either, and we've seen in the last 15, 20 years where that leads up to. So I think, do I see that shift happening? A little bit. I worry that if we keep going down this path, it might go down a bit further.
Paul, you look like you want to chime in on that.
Well, I'll say something about pricing and then maybe also rotation of portfolio. I think it's very important. Pricing-wise, and I said it a few times, the days where banks are just lending money as the pricing goes down, if that's all the banks are doing, there's a very rainy day ahead, particularly with regulation around the corner. Well, in fact, it's now. So really, as banks, we need to be offering more service than just lending. We have to bank the client, and then so the loan actually is the bit the client wants. It's the bit we need to provide, but there are other services that we can provide that will make up for it. That's key going forwards to any bank, I think, that wants to have a long life in this industry. And then, as part of that, this industry's been heavily towards a take-and-hold type of industry for years. People have chased portfolio size, and you sit on a deal for 5, 7, 10, 12 years. It hasn't had a distribution mentality. And again, that is going to change. I think if it doesn't change, the number of banks in this market are going to reduce over time because the capital will be used elsewhere by the banks. So we need to be smarter with what we do with our capital, and that means distributing to to other banks, of course, but also to non-banks, and do what other markets are doing, be a bit more sophisticated.
Yeah, I agree with that, Paul, but and when we talk about distribution, we have to be very clear what we mean, because so many of our clients are very selective as to which banks they're prepared to work with, because they still remember the financial crisis. They thought they had long-term partner banks, and then what they found is that their portfolio was sold into a fund who had a very different agenda to a long-term shipping bank. So they're very selective about who we're allowed to sell to. Which isn't to say we shouldn't do it, by the way, because I agree with you, but I think we have to do it in a much, much smarter way. So we look at things like significant risk transfers and do it that way. And that is happening. We spoke briefly about price. Look, anyone can compete on price. It's not a great business model because you just get dragged down to the lowest common denominator. Now, you might not lose money by lending it cheaply, but you won't get a good return on equity. But as Gaurav sort of alluded to, the next step once you fit sort of bottom pricing is you start sort of stretching the terms and conditions, higher advance rates, longer profiles, et cetera, and that's where you potentially lose money. And that's pretty much, I think, the stage we're at now. Pricing has got so low, we're totally mispricing risk. But there is so much, I've never seen so much liquidity in the market in 40 years. And that affects the price. And now it's affecting the structures.
And Paul, to your point about distributing, debt out, with pricing being what it is at, I mean, that could be a challenge if pricing does move up in the future. Who's going to want that with such a low return, right?
Well, today there's huge liquidity, so you can sell in primary, and there's a limited secondary market. If and when these shipping markets turn, and of course they will, the secondary market tends to die, and then the problem you're alluding to definitely comes into play.
There's a reason I'm retiring in June. Portfolio's in great shape. Get out on top, and then leave the mess for somebody else to clear up in a few years.
Right, moving on. Paul, as you evaluate the decarbonisation transition, how materially does alternative fuel or dual fuel readiness support Basel IV compliance? And how do you approach underwriting technology risk across methanol ready, ammonia ready, and dual fuel designs when the technological trajectory remains uncertain? And then within that, does ECA capability now sort of become more important for a bank positioning itself? And then given the uncertainty around US policy direction, do you feel that sustainability has lost momentum in ship finance, or does it still remain central to long-term strategic planning?
Again, lots of questions. And I'm going to start with the last one, because I think it'll be a more coherent answer for the others. So first of all, of course, there's been a bit of a bump in the road with regards to decarbonisation, but it's a short-term bump, and the road still, the destination is known, and I personally believe the industry is still very committed to decarbonisation. Just take the Poseidon principles, for example. We've got 36 banks who are using data to talk to their clients. They're having data-driven discussions with our clients, and the quality of those discussions are at an all-time high. And speaking for SocGen, of course, not at the other banks, I can say that we don't have many clients who aren't committed to decarbonisation. So I don't think the long-term goal is changing, but of course we have to acknowledge that there's a short-term blip in the road for geopolitical reasons. So just about answer that question, looking at the question about how we go about our credit decisions and underwriting alternative fuel technologies. There's not that many, let's be totally frank about it. Maybe in the container ship market, there's some methanol-fueled vessels, but otherwise we're looking at ammonia-ready, methanol-ready, and LNG dual fuel. Well, the ready ones aren't really ready at all. So what are we actually saying here? We're financing the client. It's debt, not equity. So we're looking at the client. Do we believe in their strategy? If we believe in their strategy, we'll be financing these vessels, as long as they're sensible structures. So I don't think we have to look at the technology risk so much in our debt decisions if we believe in what the client is doing, if we're happy there with that. So it's more a corporate-driven approach rather than a technology one. Which brings us on to the lending side, and your question about Basel IV and whether alternative fuel technologies get any benefit. I think that's the question you're asking. And I would love to say yes, but the answer is no. At the moment, the regulators don't give banks any meaningful or any benefit at all in terms of our funding costs, in terms of the capital relief to finance green vessels. So if you see cheaper transactions or some form of pricing relief in transactions because there happen to be alternative fuels. It's purely the bank dropping its price to win the transaction. It's coming out of the bottom line. And it's really normal market forces which is driving that play. It's not anything to do with subsidies at the moment, which is a real shame. But of course, the regulators are looking at, in terms of giving capital relief, it's based on risk. At the moment, they don't see the greener technologies as a lower risk. You can argue it's the opposite. So at the moment, there's no pricing relief. And that brings us to, I think, the final question, which is what role does the ECAs play in this? I think having an ECA capability is pretty important at the moment. One, because, of course, an awful lot of transactions coming out of China and Korea require ECA cover, and that's where the main ECAs are. But also under Basel IV, under the standard approach, the Korean ECAs in particular, because it's sovereign risk, they get a much lower capital or lower rating, or weighting rather, and less capital relief, or more capital relief, less capital put aside, sorry. Therefore, they can be priced much cheaper. So if you have an ECA capability, you can price much more competitively. So I think it's absolutely vital to have that, but as we've seen across this market, there's a lot of liquidity outside ECAs.
Gaurav, did you want to chime in on how many of your clients are you talking sustainability with, and is it an important part of your kind of credit process?
No, absolutely, and I think similar to what Paul said, I can't imagine that there is any conversation we have today with any client that does not involve a conversation around decarbonization. So 100% is the short answer. And it is very much a part of the credit process, but it's also just an overall evaluation around the deal process, right? So as I've said for many years, it's gone from a good to have to a must have to, if you don't have an answer to that question, you're not getting to that next stage. So it is becoming very, very critical for us. Just touching on the Basel point, as I said, I think it would have been good to see some relief, but you don't see any. In fact, I think there's been some rollback on some potential reliefs that were at least in, if I remember, in the EU, and they might just be taken away. So it's something that I don't think is going to come anytime in the near future, but we'll just have to the banks have to have a strong agenda to keep pursuing this, and I mean, at our end, we definitely are.
Mickey, maybe you can offer a contrary view.
I would just add that we're still playing in a global market with new entrants and new liquidity joining every day, playing by very different rules under very different regulation. Same as ship owners, depending on where they're based and where they're trying to operate. So it makes it really hard to compete for someone who's following additional rules against someone who isn't. And market's going to choose. If they have the opportunity to go do something for the same value at a lower cost, that decision is a foregone conclusion unless they have some additional shareholder, stakeholder requirement, either externally or internally set. So it's all well and good to do this noble effort, but if you can't move the needle, then you have to revisit why we're doing it, how we're doing it, and that goes back to Net Framework Zero and everything. If it's not working for the majority or enough to even get it over the line, we just have to take a step back, and maybe the great pause is going to bring us to a much better place in the end, but that's how I would view it.
So moving to geopolitics, it's obviously doing a lot of the work for us today. China, Venezuela, even Greenland creeping into the conversation. How is that actually showing up in your deals, in compliance, in pricing, in where you're willing to deploy capital? And are East-West fleets now different credits? Is the move away from Chinese leasing real or just talk? And what do you need from borrowers for deals to remain feasible?
It's an important and topical question, but for us, we stay the course. You have to focus on bigger picture, longer term. These are long-lived assets and long-term relationships. There's always going to be some noise and geopolitical winds that you have to navigate. So for us, it's a key focus on compliance, not just today, not just this year, but always. That's our ability to do business. You can't break the toy. It's OFAC list. You don't want anything to do with it, and there's a lot of murky waters out there. So we stick with the clients that we know, the assets that we know, and that keeps us on the right side of a lot of these issues. Owners are spoiled for choice right now in terms of where they want to borrow, how they want to borrow. You talk about east, west, and I touched upon it earlier on the shift in some of the demand for the Chinese leasing. We still see plenty of owners opting for it. So it might be anecdotally happening, but by and large, they're a major player. They continue to be. Adam Kent earlier said, great pause. I like that phrase. So maybe owners were waiting to see what would transpire. There was a busy weekend in October for a lot of owners, rerouting their ships, and it creates a lot of noise. But for us, the focus remains our commoditized asset space, which are bulker, tanker, container, including gas carrier. And our owners are in the Americas and in Europe. And these are markets where we can stay close to the client. We can focus on what's important to them, and we can carve our own space, whether it's on a non-recourse project financing or joining into a larger facility with some of my colleagues up here. So we have a bit of flexibility as long as we're happy with the asset and with the counterpart. The structure, we can be creative. And I think the last part was just a little bit around, remind me.
The borrowers. So what do you need from borrowers
Yeah.
for deals to remain feasible?
Well, I think we need from them what they need from us, which is execution certainty. We'll do the work, and we'll spend time getting where we need to be and bringing a credit application through our process, because you're going to do a lot of repeat business with good clients if they're acquisitive and if they're in long for this market. That said, we also have financial clients that are in for the life of the fund, and then the strategy may shift. So as long as you go into the project and into the relationship knowing what to expect from it, then you can set reasonable expectations and spend your time wisely on where to focus. There are many owners in different markets for different reasons, some successive families for generations, and those play an important part in our portfolio. We also have, like I said, the financial sponsors that will maybe wait for the next cycle or sit one out. So as long as you know what you're going into, we're there for them, and you can do a lot of business that way.
Kai, I wonder whether you want to comment from.
Yeah, I mean, I think that's the for bank that's the right strategy and also kind of the obvious strategy. What I see and what I think is quite amazing is how much Asian banks are coming now to Europe. So when you say the margin needs to go up. Right now, I see actually the development in the exact opposite direction, because not only private credit is coming in, but Asian banks are coming in. And I mean, in the past years, it was like you need to be 20 times in Tokyo before any bank would speak to you as an owner. And now Japanese bankers are coming to Europe and speak to your clients directly. So I think the pressure is even going up, and I obviously understand the politics and the strategy behind the banks here on the panel and other banks as well, sticking with the clients. But the question is, how long can you do that if the pressure is even going up than going down?
I just want to come back to the geopolitics subject, because one of the great things about ships is that they're movable, and therefore to quite a large extent we can shield ourselves, and the owners can shield themselves from a lot of that geopolitical risk. And of course, I mean, you all know, Kavita, that when Sovconflot was sanctioned, that was something that I was heavily involved in, and we managed to get all of our money back. Now, had I been lending to an onshore project in Russia, or actually even aviation, it would have been a very different story. So you can shield yourself against that geopolitical risk much easier than you can in other industries.
Yeah, and it's a global market. You've got Western banks lending into Asia, and you've got Asian banks lending into European deals. So I don't think there's any of this two-pronged market with looking at Western credits and Eastern credits. I really don't think that is the way any bank will look at it. Of course, we look at all these geopolitical issues as part of all our transactions, but that's on a transaction-by-transaction basis.
Okay. Stephen, moving on to you. The market feels increasingly crowded with the same group of banks pursuing the same transactions. From your perspective, I mean, we've heard from Paul about cross-sell. From your perspective, what differentiates a bank today? Is it structure, risk appetite, relationship, strength, cross-sell, or something else entirely? Connected to that, which segments are you leaning into? Which are you moving away from or trimming? How's borrower behavior helping or hindering that? And what would you like to your owners to do more of, or what would you gladly see less of?
Well, I'd like them to pay higher margins. That's the easy one. Look, how do we compete? You've guessed from what I said earlier, we don't want to compete on price. We have to be competitive, but we don't want to compete on price, nor do we particularly want to compete on structures. We know what we want to do. Where we try to compete is what we are is relationship bankers. People think that we're transactional, that we're simply asset financiers. Of course, we do finance assets, that's our business, but what we are fundamentally is relationship bankers. And we have to be predictable towards our clients. And I think a question was maybe Mickey talking about what do you want from your clients and what do you want from them. The answer is trust. And in terms of sectors, again, it's the three main sectors. We're fairly sector agnostic as long as the assets are homogenous, because we need a lot of data for the models. But fundamentally, it's about who's the borrower. Do you trust them? What's their track record? Are they going to do the right thing when the chips are down? And some owners do. Fortunately, all of ours do. But we have had instances where they don't, and I'll never ever bank them again.
Yeah.
Was that 2 minutes?
Perfect. I'm not going to open it to the rest of the panelists because I want to just finish with one very quick question for each of the panelists. One sentence answers only, please. Looking 3 years ahead, what is the single biggest change you expect in ship finance, and one thing you perhaps hope remains the same?
I'll go first very quickly. I won't be in ship finance in 3 years. That's one change. What do I hope stays the same? ING's strategy towards our shipping clients.
Paul, do you want to go?
I'll stick with my one about bank distribution. I think banks will be more facilitators of debt rather than just providers.
Gaurav?
Yeah, I think it's going to get more and more relationship-driven and more relationship value-driven as opposed to sort of asset financing and transactional.
Mickey?
I echo Steve's answer, and I'd like to just say we really appreciate everything you've done for us in this industry. And as you are transitioning into the executive chairman role and beyond, there's maybe some new hobbies in here that can help you along the way if you get any quiet moments.
Thank you very much indeed. Thank you. Very unexpected.
And kind not to leave you out.
I thought that's a nice ending, but it's not
quite the end.
Well, what we see, I would say, it's becoming more normal that you see more owners, smaller owners, mid-size owners, playing the whole piano, the whole book of financing, and are more open to alternative structures, which I think is a good thing also for the traditional banks.
Thank you.
Thank you.
Thank you to Marine Money as well.